Hey, hello, Coachella Valley in Southern California. This time of year for most places is called the shoulder season. It's kind of that transition from one season to the next. Well, I'll tell you right now, I can shoulder this weather all day long. It's about 88 degrees outside. The schmutz that was here last week is gone. The Coachella festivals and the whatever the other one is, Stagecoach, they're all left town. It is absolutely glorious. And I couldn't ask for a better day to have on Art Alvarez to bring us up with what's going on. Because you know what? It has been let's kind of say it's been one of those roller coaster weeks of what's going on in the market. So I can't wait to bring him on. Let's talk to Art Alvarez with MortgageWorks. Hey, Art, how you doing?
Hi, Jeff. How are you? Good.
Good. As I said, it is a crazy time right now. A lot of things going on. I can't wait for you to dive into it. I know you got a great show lined up.
Yeah, I think so. In fact, I'm going to borrow your schmutz term, because last week interest rates were kind of schmutzy, and I think thankfully we've had a little bit of encouraging improvement this week, especially the last day or two, which I'll touch on here in a minute.
Well, before I let you go, I saw that, was it 2 days ago when the market went down almost 1,000 combined points? It was a little scary.
Yeah.
It's like being on 100 foot on that wire and there was no net because
Right.
it's like, what are we going to do now? Well, it seems like things have calmed down a bit.
Mhm.
With that, Art, I'm going to turn it over to you. Before I let you go, I just want to let those folks knowing whether they're coming in live or they're watching afterwards, please put your comments in the comment section. If you're here live, I'll be in the background and I'll feed them over to Art. He likes to answer those questions on the show, during the show, so you can have your answers because he's from MortgageWorks, where they have the answers and they're on the house. With that, Art, I'll turn it over to you. Have a great show.
Okay. Thanks, Jeff. Hello, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where, as Jeff says, we do have the answers and they're on the house. What I want to jump into right now, of course, is giving an update on mortgage rates and the bond market. Jeff and I were just joking about, I mentioned using his term schmutz, schmutz in the air, as he mentioned on our weather out here last week. But, I just told him our mortgage rates were kind of schmutzy last week because there was a lot of concern about rates going up, the very hot inflation numbers and so forth. Well, Jeff just pulled up our rate grid, and thankfully we've had a little bit of improvement. As you can see here, we're back down just under 6% on conforming 30-year fixed. FHA and VA holding in there well at 6.25. Even jumbo loans now back under 7%. So that's good to see. And part of that, in fact, a lot of that has to do with the bond yield. The 10-year bond yield, as you know, is what I like to refer to often. And we're going to show you the 5-day chart for the 10-year bond yield. And there it is. And you can see how end of last week, the yield was getting pretty up there. It was almost 470 or so. And then we had some improvement early this week. But then basically Tuesday afternoon into Wednesday, the bond yield started to creep back up again. That is actually fairly typical because guess what? This week we had the Fed's 2 days worth of meetings, the Federal Open Market Committee meetings, as it's officially called. And usually bond yields tend to run up before that meeting as all the hand-wringing starts as to wondering what the Fed's going to say when they conclude their meeting. So that's not unusual to see the bond yield go up before the meeting. And then, of course, you see it come down afterward, which I'm going to touch on here now. The first thing I want to point out in terms of data this week, not a lot of data, economic data that is, that might affect the bond market, not a lot of data early this week. In fact, probably the biggest news early this week was the Case-Shiller Index. As you may recall, Case-Shiller has become pretty much the go-to index for determining where our home price is going. And guess what? On Tuesday, the Case-Shiller Index was released for February. And it was up. Home prices up. Again, this is a national number, up 7.3%. So as I put on the slide, are you waiting for home prices to fall? Nope, that's not happening. Up 7.3% in February, year over year. That's an all-time high. So folks, all of you who have been waiting, not getting into the housing market to look to buy a home, maybe your first home, because you're waiting for home prices to fall. I'm telling you, waiting is costing you because home prices have only been going up. Now, they're not skyrocketing 20 or 30% a year, but a good 5, 6, 7% a year is pretty good appreciation. And so the longer you wait, the more you're missing out on that. In fact, even Dave Ramsey was in the news this week and chimed in on the same issue. He again reiterated his prediction that, first of all, home prices are not going to fall. They're not going to collapse. And he's predicting home prices are going to go up further. And he, of course, blames really or points to two things about that whole issue of home prices. Number one, he says, ignore what you see on the internet, all the doom and gloom about home prices falling. He says, ignore that because it ain't happening. And then number two, it's all about inventory, supply and demand. There's still not enough inventory. And I would keep arguing the amount of buyer demand is so great, even when inventory does start increasing, as it has a little bit, that's not enough to bring prices down. So you got to get in sooner than later if you want to take advantage of those future higher home prices that are apparently sure to come. Data that came out yesterday, JOLT, that's the job opening labor turnover number. It actually dropped 8.5 million. It's been running around 8.8 million. The forecast was for 8.7. It came in at 8.5. That's an indication that maybe the labor market is weakening. If there's less job offers out there, less job ads, that's an indication employers are backing off on hiring more workers. So this is considered a soft number. Now, what really occurred this week, what all the improvement or change in sort of the emotional context of interest rates was the conclusion of the Fed meetings. Yesterday, at the conclusion of the Fed meetings, it was announced that the Fed funds rate would remain unchanged yet again. The Fed is holding steady. The Fed funds rate has not been raised since July of last year. So we're literally approaching almost a year with no increase in the Fed funds rate. So it has been extremely steady, right? Also, the Fed, as part of their press release and the interview that Powell did at the conclusion of the meeting, he did point to a lack of additional progress toward the 2% inflation target. We're still hovering around 3.5% to almost 4%. So that is still a concern of the Fed. But what he did say, what the Fed minutes release indicated, or the press release indicated, and this is what got the markets back on a positive plane, is, and this is a quote, it's unlikely the next policy move will be a hike. So that really gave the markets a lot of reassurance that the concerns about not only are they going to not lower the Fed funds rate, but the concern they might raise it, that seems to be off the table, at least for now. So that's good news. That's why we've come off of that 470 10-year yield, and now we're back down under 460. At last check, about 457. So that's really good. Good improvement, and it would be great if we can see that go a little bit more and get under 4.5, and I think that could happen. Rest of the week, watch out tomorrow for the ISM, that's the Institute of Supply Management Services Index. That is a gauge of the service economy, which of course is the biggest part of our economy. And then tomorrow also will be the wage and employment reports, including claims for unemployment. Including new job openings as well as, or new job hirings, I should say, as well as what the unemployment rate is going to be. So let's watch that. That could be helpful if those numbers aren't too strong, and maybe we'll see some more improvement in the 10-year bond yield. So again, pretty good news this week. Got a reverse of that negative trend we've seen the last couple of weeks. So now what I want to get into, I saw an article earlier this week, but boy, it caught my attention. I thought, I've got to talk about this. And what it had to do with is millennial wealth. And the reason this article caught my attention, I don't know about you, but I've seen all kinds of news articles over the last several months, even year or two, where millennials appear to be kind of, concerned and kind of moaning and groaning about the fact that they just are having trouble with, their income is not as good as previous generation, in particular the baby boomers. The baby boomers are buying up all the houses, and the baby boomers were lucky because back when they were at millennial age, they could more readily afford a home, and their incomes were better than current millennials and so forth. So I've seen a lot of news stories and headlines all about those kinds of concerns. Well, this particular article seem to go counter, which is why I wanted to bring it up. And here's the title to the article: Millennial Wealth is Booming. It turns out avocado toast didn't tank them after all. I thought that was a great line. This is from Business Insider on April 24th. And so some of the data that was in this article was really, really surprising, and I wanted to share it with you. For example, historic growth. Millennials' wealth surged from 2019 to 2023 despite the pandemic recession. And it was fueled by factors like a strong labor market. This was from a study by the Center for American Progress. The article mentioned that's a left-leaning organization. I'm not sure why that needed to be pointed out, but it's a report that's based on data from the Federal Reserve. And it was interesting, the wealth growth. Average wealth of households under 40 grew by 49% from 2019 to 2023, with millennial wealth doubling during the same period. Well, isn't that interesting? Again, I've seen so many news articles, news headlines about millennials, complaining about their wealth hasn't kept pace. Well, this data would suggest otherwise. It also pointed out that millennials, our current millennials, fared better financially during the pandemic recession compared to previous generations like Gen X, who had to deal with the Great Recession of 2008, or baby boomers like myself, when we had to deal with an economic downturn in 1990, back when us boomers were in that age bracket of 26 to 44 years of age. Well, this article points out that our current millennials weathered our 100-year pandemic much better than the Gen Xers of 08 or the baby boomers of 1990. Well, again, isn't that interesting? Now, the factors that contributed to this millennial growth, this explosion of millennial wealth, was a robust labor market, and I think even more importantly, pandemic era stimulus measures such as cash payments and student loan pauses fueled by millennials' wealth surge. In fact, student loan pauses. Good point. For all the complaints about crushing student loan debt, folks, I got to tell you, for the last several years, every time we originate a loan with somebody with student loan debt, it's on the credit report, and 98% of the time, the payments are deferred. So yes, there's a lot of student loan debt out there. That burden is there, but in terms of it, is it having an impact on millennials currently in terms of making those payments? I would argue not really, because they've been in deferment in some cases for many, many years. Now, again, that's there. It's a burden. It's going to come, but in terms of current activity, it hasn't really been that much of a factor because the payments have been deferred. The borrowers have not had to pay them. And the other thing the article pointed out was wealth gains were not limited to just top earners, the top millennials. It was broad-based across all demographics, including indicating widespread economic improvement. So I just wanted to point this out, that despite all the complaining about millennials just don't have it as good as previous generations, the Gen X or the boomers, this article seemed to suggest otherwise. So I wanted to make that clear, because it's my opinion based on what I see in dealing with prospective home buyers every day. There's a lot of millennials out there who are in better position to qualify for a mortgage, even at current rates, than they think they are. And what I think would help them if they talk to somebody like us, where we can show them the numbers and give them some ideas and strategies how to deal with current rates, current home prices, and help them realize that they really could afford to buy a home more than they think. And so in that respect, I just wanted to share that information and get that message across. Millennials, those of you out there, if you're still thinking you're not in a position to buy a home, be happy to have a discussion with you, and let's look at some numbers, and let me see if I can help you realize that objective of owning a home is in closer reach than you think. And with that, I want to go into what's becoming a regular segment on our program, and it's about a temporary buy down. I call it "Buy Downs Are the Bomb." And with this particular example, in fact, it kind of underscores the millennial article about wealth creation and booming wealth of millennials, as well as this example also underscores, not long ago, I talked about, houses without spouses, about the idea of buying a home with someone who's not your spouse. So this particular example I'm going to show you, it's a real life example of a transaction I'm working on right now. It first came to me about 2 days ago. Today's Thursday, May 2nd. It was 2 days ago. On Tuesday, I had an agent call me about this listing and indicated she wanted me to pre-qualify buyers for this property. And the buyers are two brothers, okay? Two brothers who are looking to buy this home together, and they're going to live in it. This is an actual property here in the Coachella Valley in my market here directly. It's an SFR featuring 3 bedrooms, 2 baths, 2,100 square feet. It's in Palm Desert, listed at $599. Now, it's an older home built in 1953. It's been on the market for 14 days. There's been no offers and no adjustment in the list price. The listing says the property's been updated and remodeled, including the roof and AC. I took a look at the listing and the photos, and it's true. The property looks pretty good. They've done a good amount of work to it. Now, at this particular list price of $599, when the agent contacted me, it was indicated to me that they were contemplating making an offer $49,000 less. So they wanted to offer $550 on a $599 purchase price. These two brothers want to use a minimum down payment. So we're looking to use an FHA loan with only a 3.5% down. So with those parameters, a $550 purchase price with a $540,000 loan amount, that's the minimum down payment. The principal and interest at an FHA rate of 6.25% is $3,325. So keep that in mind. That would be the kind of terms they would get if they simply made a $49,000 below list price offer and got it accepted. So when they told me this, I asked if I could provide them another alternative. So this is what I want to show you now. So what I suggested to them is to not offer $550 without any other seller concession. I suggested they should offer $575 and then request a $25,000 seller credit that would be used for a 3-2-1 temporary interest rate buydown plus closing costs. Now, if they do that kind of an offer, their loan amount will be higher. It'd be $565,000 instead of $540,000. And again, that would be based on a 3.5% down FHA loan. Well, for the note rate at 6.5%, with this $575 offer and $565 loan amount, at the note rate of 6.25%, the principal and interest payment would be $34.76. However, with the 3-2-1 buydown, the first year rate to the borrower, to the buyers, is going to be 3.25%, not 6.25%. Their principal and interest is only going to be $24.57. That's $1,019 a month lower than the note rate payment. Second year, $27.77 at 4.25%, $699 lower than the payment at the note rate of 6.25%. Third year, principal and interest $31.17. That's based on 5.25%, $359 a month lower than what the note rate payment is going to be in the start of year 4. Over those 3 years, the buyers would save $25,000 in payments over that 3-year period versus just taking a market rate payment with no seller concession to be used toward the buydown. So again, this is a real life, clear example of how temporary buydowns at or near full list price features superior payment terms over lower price offers. Now, at program time, I haven't heard if they've gotten their offer accepted. I believe they submitted it last night. So we're standing by to see if these terms that they offered get accepted by the seller. And one of the things I did discuss with these buyers, these prospective buyers, they may get a counter. The seller may think that their offer is a little too aggressive. If so, these buyers are prepared to go up as high as the list price of $599, but they'll still insist on this $25,000 seller credit so they can use that to get that 3-2-1 buydown schedule, as well as remaining amount of cash, which is about $5,000 that would be applied toward closing costs. So again, this is a perfect real life example of temporary buydowns in action. I put this together, issued the pre-approval letter to the agent yesterday. She's made the offer. We're simply waiting to hear. And maybe at our next program, I'll give you an update to see if their offer got accepted. And if it did, what terms did they finally settle on? So again, this is a very good example for any of you who are on the sidelines about getting into the market to buy a home. This, in my opinion, is a key strategy to use in making those efforts to buy a home. I'd be happy to help you with that. Feel free to contact me and we can have a discussion and I can give you some numbers on particular scenarios you're interested in. So with that, that's this week's buy downs are the bomb. And with that, I want to go into another subject, which I've talked about a lot. I'll admit it. It's about equity loans, HELOCs. An article came out this week talking about the HELOC dam is opening. And are you ready? Now, this was actually an article, frankly, that was written more for an audience of mortgage originators like myself. And of course, it got into the modern day solutions to tapping into the record high home equity. What I wanted to share with you in this article is, number one, just the data. It was recently announced record home equity now exists in the U.S. U.S. homeowners hold nearly $32 trillion of equity. That is tremendous. That is an amazing number. Now, of course, part of the reason for that is a good amount of those homeowners. In fact, it's estimated 90% of homeowners with a mortgage have a mortgage under 5%. So what that means is those homeowners are hanging on to those homes for a longer period of time. They continue to appreciate, and that's part of what's creating some of this record home equity is because of these low interest rates that many homeowners are reluctant to refinance, and they prefer to tap into their equity with a junior lien, that is a second mortgage. So demand for HELOCs is surging, has been surging, frankly. It's still surging. Although I would argue maybe tapering off just a little bit, and for a reason I'll touch on in just a second here. But as this surge in home equity lending continues, one innovative solution, as the article called, and I would agree with it, is the non-QM portion of the market. That's the non-qualified mortgage segment. That's the segment of the mortgage industry that serves borrowers who can't meet conforming guidelines, particularly on income, meaning they can't qualify based on providing their pay stubs or their W-2s or their tax returns. So they need alternative financing that'll still get them approved. Well, one hole in that non-QM segment of the industry is until recently, there was really no solutions for homeowners, in particular self-employed homeowners who owned a home, had a lot of equity, but again, couldn't qualify for conforming terms. That is to say their tax returns didn't show enough net income to qualify, even though maybe they owned a business with very good cash flow and so forth. So one recent innovation in the home equity lending segment of the industry is we now have bank statement HELOCs. Now, you might remember we've had bank statement loans for quite some time. Those are for purchase or refinance, but those have been for first mortgages. And they're primarily designed for self-employed folks who can provide bank statements, either 12 months or 24 months. And then we calculate their qualifying income off the business deposit activity into their account. Well, happy to say that now that approach has been expanded into the equity loan market. So we can now arrange a HELOC for a self-employed borrower using your business bank statements for qualifying income. And that way we're able to get you that HELOC tailored to your particular situation. So I want you to all be aware, particularly if you're self-employed, if you run into trouble getting a equity loan, a HELOC, or my next subject, a HELOAN, we can give you that alternative to get you that equity lending based on your bank statements, not on your tax return. So just give me a call. Be happy to discuss the details of the program with you and how it can help you in your situation. The other thing I want to point out about this article and the fact that equity lending continues to be a robust part of the industry is we're seeing more and more interest in and popularity with HELOANs. Now, what is a HELOAN? HELOAN is home equity loan. It's intended to describe a traditional fixed rate mortgage, not a revolving line of credit like a HELOC is, home equity line of credit. That's a revolving line of credit like a credit card. A HELOAN is just a traditional fixed rate loan, home equity loan. It's a fixed rate loan that's available with terms as short as 5 years and as long as 30 years. I can arrange a loan amount for a HELOAN for you for up to $500,000. Now, in pricing these loans, where there's a pretty good, what I call sweet spot in terms of how these are priced, is a 20-year term. And if you need a loan amount of $200,000 or more, that's where you're going to get the best pricing if you have a good high credit score such as 780, and if you have a lot of equity. For example, if you need $500,000, you've got a 780 credit score, and it's on your primary home, and maybe your primary home's worth $3.5 million, and perhaps you have $1 million on a first mortgage, and it's at 3%, but you want to get 500 grand, you want to pull it out of your home. I can get you a $500,000 fixed rate second, 20-year term, and you're going to have an interest rate in the under 9. It's going to be in the mid 8s. So this is a terrific alternative equity lending approach to HELOCs. And what I'm telling you is I'm seeing more and more people interested in the HELOan. There's, some homeowners are just worried about HELOCs because they are variable rate loans. What if rates do go up further? Will HELOCs be a victim of that? Possibly. So some homeowners are looking at a HELOan because they like the idea they can cap the rate. The rate they get is fixed for the entire loan term, and their needs for the money are maybe a little bit more on a situation where they have a particular need for a particular reason, like a extensive home remodeling project or purchase another property. They're not really interested in getting a revolving line of credit approach, using the loan as a rainy day fund, as some HELOCs are used for. No, this is for usually a specific purpose, a specific amount of money. Excuse me. And once they get that money and use it for what they need it for, they just pay it back over the loan term. So keep that in mind. HELOans are a good alternative to HELOCs, and we're seeing more and more interest in them. Okay, with that, I'm going to go ahead and go into our closing question from last week. And it's probably it's the age-old question in the industry. We still run into it all the time. And in fact, I just was asked this again about 2 weeks ago, so I thought I'd cover it once again. And we actually had a question submitted to us that read exactly as you see at the top there. Okay, I still don't get it. Tell me again, what the heck is an APR? Well, as simply as I can tell you, the annual percentage rate, or APR, represents the total cost of borrowing money for a mortgage, including the interest rate and certain fees expressed as a yearly percentage. But here's even a more simple way to describe it, and the way to think about an APR. The more fees you pay for a particular interest rate, the higher the APR will be over that interest rate. So in other words, if you're going to get if you're going to get a mortgage for 6.5, and you're getting it at 0 points, and then another person over here is getting the same mortgage for 6.5, but they're going to pay 1 point. Well, even though both borrowers are both getting 6.5, those offers are not equivalent to each other. Why? One borrower is having to pay 1 point to get that rate. The other borrower is paying 0 points to get that rate. That 1 point that one of the borrowers is paying, that is a fee that is incorporated into the APR. In other words, they total up the amount of fees you pay for a particular rate, and then they express that as an annual percentage. What are the most common fees that will affect APR? Origination fees, points, both discount points and loan origination fee, the classic 1% origination. Mortgage insurance, that's a big one. Lender fees, like lender admin fee, underwriting fee, processing document fees, as well as escrow fees. So the basic idea is the more you pay for a particular rate, the more you pay in these kind of fees, the higher your APR is going to be over your note rate. So that way, if two borrowers, or if you're looking at two offers, one from two different lenders, and if they're both offering the same rate, but one lender's quote has lower fees than the other, then that lender's quote is probably going to have an APR, and that's a clue to you that that's probably a better deal. So again, hopefully that helps you understand a little bit better about how APR works. But if I leave you with nothing else, please just keep it as simple as possible. The more fees you pay for a particular interest rate, the higher the APR over that interest rate will be. Okay, so hope that's clear. If you have any more questions, feel free to reach out to me. I'll be happy to talk to you in more detail about how that works. And finally, then we'll go to our closing question for next week. And I just ran into this, the end of last week, last Thursday, in fact. And I'd gotten a call from somebody who was looking to buy a manufactured home. And here's what their question was. They told me they were looking at purchasing a manufactured home. but they had somebody tell them, I think a friend or family member, that it's important that it has a 433A recorded. So their question was, what is a 433A and why is it important? Well, actually, it's very important for financing on a manufactured home. So next week, I'll have the answer for you on that, and it will be on that. It'll be on the house. Jeff, back to you.
All right, another great show. It feels like it takes the monkey off our back because the millennials are not suffering because of these gray-haired baby boomers. Thank you for clearing that up.
Yeah, I had to do that because I agree. I mean, we talk about it all the time. Beware the headlines, and Dave Ramsey's like, ignore what's on the internet. But it's so true. I mean, there's so many. I hate to say it, and I don't want to, offend any millennials out there, but there's so much whiny news about the difficult path that our current millennials have had to pursue, and it was interesting and kind of refreshing to see an article with some data that, counters that narrative.
Yeah, I think if we probably go back in time in history and when we were their age, the news was probably the same. It was just a different group of people. And it kind of goes to that whole thing of like, if it bleeds, it leads. So if our heart is bleeding or we're whining, we're probably going to be in the news, and it's only those select few, and it's worth writing a story about. So it really is good to have that freshened up. The other thing I wanted to ask you or really comment on are these HELOCs and HELOANs. And I know I've heard you say that the rates for HELOCs have not changed in quite some time. I've noticed on your rate chart on your website, those rates seem to be pretty steady.
Well, that's true. And fundamental reason why is on a HELOC in particular, the HELOC is tied to the U.S. prime rate. That's the index that's used. And the U.S. prime rate has been an 8.5 since last July. Now, some HELOC lenders will adjust their margin over the prime rate, which ultimately does set the rate. And some lenders have tweaked their margins a little bit since last July, so that, you can see maybe some slight differences in rate from time to time on a HELOC. But overall, the key component of a HELOC rate is the index, that prime rate at 8.5, and that hasn't changed since July of last year. So that's why HELOC rates overall really have not moved hardly at all in almost a year.
That is really exciting news. The other thing is, and I was just speaking just before I got on the show today, I was just speaking to a real estate agent down in Poway, Southern California, down there, San Diego area. And she said she's speaking to someone who's considering moving from Central California to San Diego, and they're dragging their feet because they're thinking if they wait till the interest rates go down, they can possibly save some money. That Case-Shiller report talking about how it's grown 7.8% over year, that pretty much debunks that myth, doesn't it?
Well, it does. And again, the first thing I think too is I'll have to check, but I think the San Diego market in particular has fared even better in terms of increase in property value. So if they're looking at San Diego as where they want to be, then again, this is another example of the strategy of, I'll just wait till rates get better before I move forward. Well, again, I'm not, we don't know what kind of rate they're waiting for, but chances are they're waiting for a rate level that's far off. So then in the meantime, how much more are those prices going to go up? As we just demonstrated with our this week's, buy downs or the bomb, what they really ought to reconsider is, do some looking in San Diego, find a property that's maybe been on the market for, 20, 30, 40 days with no offers, no adjustment in price. Go after that with a 3-2-1 buy down. That way you can get that ownership now, and then you've got a 3-year window to wait for those rates to drop, and then you just refinance that buy down loan. Again, marry the home now, date the rate.
I think I'll have to off air. I think I'll have to give you that real estate agent's information and send you the contact so that you can talk to her about the rate buy down and also, more reasons why not to wait, because it is not it's like building house on the sand. It is just eroding your opportunities. So, Art, as always, your information is fantastic. It's really in depth. And again, it peels back the layer of those headlines. I just love the way you take these articles, which could be so misleading if we just read the first paragraph in the headline. We certainly are going to be the henny pennies of today, and we're going to run because we're thinking the sky's falling. So thank you so much.
Oh, you're welcome. Anytime.
Hey, to get a hold of Art, please contact him at MortgageWorks. You see his information on the phone or on the screen there at 760-883-5700. That's his office number. And of course, his red cell phone, which is always on, is 714-612-9035. Yes, even when he's traveling to the Sphere in Vegas, he will have that on for you. Nothing changes. And of course, you go to the website at mwloan.com. That is a great resource to find out, hey, what are the rates today? And there's a whole bunch of tools on there right below the rate chart that you can check out that are very, very valuable and helpful. And of course, always drop Art a line at art@mwloan.com. Art, thank you so much again. I'll tune out and have a great afternoon.
Okay. Thank you, Jeff. Thank you, everyone, for watching this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we do have the answers and they're on the house. Stay tuned until next week. So in the meantime, see you later. Take care. Bye.